Hey everyone, my name's Matt, and if you can't tell, I need a haircut. But beyond that, today's also Watchlist Wednesday, so let's go ahead and just get the intro rolling, and we'll go ahead and just jump right into this. Oh yeah, that's my job. Alright, and so the company that we're going to be reviewing this week is going to be Home Depot. Now, I'm sure everyone out there is familiar with Home Depot, but I'll explain the reason why I thought Home Depot might be a good investment or something worth taking a look at right now. And that's because with everything going on, home sales have been interesting. They've been taking place, but they haven't been as consistent as they are this time of year compared to previous years. And so some people view that as Home Depot sales should be going down, but other people say that it should be going up. Reason or thought process there is if people move into new houses, they have their own kind of tinkering or adjustments that they would need to do to the property. And other people feel that if you don't feel comfortable moving right now, then it might be a good time to enhance your home, whether that be, finish that patio project that you have or paint a room or anything along those lines. So I think it's an interesting industry or an interesting place to be in a time like this right now, and that's why I wanted to take a look at it. So the very first thing that we'll talk about is going to be the earnings call. Now, through the earnings call, there's just a few things that stood out to me, and I'll go through them relatively quickly here. The first thing that stood out to me is that their focus is on the client experience to gain more market share. That one's kind of a given. I think everybody's after that goal, but they're really focusing on just enhancing that client experience and trying to make it worth your while to, if you have to drive a little further to go to Home Depot over like a Lowe's or an Ace Hardware. They also are trying to use their online platform for growth. And so I like that idea. I think that there's a lot of Home Depots already established. I'm sure that there's somewhere out there that is needing a Home Depot or a Lowe's being built by them, but the online experience to me is something definitely worth investing in. Yes, it's a new kind of infrastructure, but ultimately I think that it would be cheaper for them to focus on that online experience rather than developing new stores, hiring new employees, going through training, all of that. So, I like to see that they're focusing on that online experience, and one of the ways that they're actually doing that is they're using their online reviews in stores. Basically what they'll do is they'll have these like smart labels next to items that you're considering purchasing. You could scan them with your phone and it'll pull up the reviews that they have on their website. Because that is a big driver of why people shop online, is because reviews are readily available. So, you're not standing there comparing two different things like, oh, which one is it that I really need, which one's better, which is going to last longer, and you could really do that comparison in stores right from your phone. So I thought that was a unique idea, and that's something that I'm excited to see. As well as they had one more thing that really stood out to me from this earnings call, and that is that through their online orders, 50% of the online orders actually result in an in-store pickup. So people are choosing to still go in stores to pick up these items, which I believe could also be a huge driver of in-store sales, basically just off impulse items. So, I know when you do those pickups, you don't really have to go too far into the store, but maybe you're thinking to yourself, oh, while I'm over there, I'll pick up, seed for my lawn, or I need some new screws or cleaning supplies or anything along those lines. So I just thought that was a really unique statistic, and it was something that I like to see because I like seeing with stores that both have a physical footprint as well as an online presence. I like to see them combining those. I think Walmart's been doing a great job, so I think it's going to be interesting to see how other sectors or other companies like Home Depot are going to make it so going in stores is still worth your while also utilizing the online resources that they provide. All right, so after listening to the earnings call, the next thing that I took a look at is the financials. Now, I've mentioned this before, but it is always just kind of worth mentioning again, is one of the things that I like to do when I'm looking at the financials, even before I look at the stock price, is I always compare it to a competitor. With us looking at Home Depot this week, the obvious competitor is going to be Lowe's. I think that's just the purest play, similar styles, almost the exact same business. But there's a few differences that I found. So what I'll do here is I'll just pop up on your screen a little chart that I made. This will make it maybe a little bit easier for you to follow along with. but there was a few numbers that stood out to me. Now, the payout, we'll start with the PE ratio. So Lowe's has a better PE ratio, which generally I like to see because that might mean that the company is undervalued. Not all the time is it a good indication, but it is something to look at. But that's why we also look at these other numbers and don't just use one exact number. But obviously Lowe's has a little bit lower of a PE ratio. As long as it's under 30, I am one of those that follows that PE ratio should be under 30 thought process or theory. And as long as it's under 30, that's okay with me. Now, again, that does vary sector by sector, and it's never going to be consistent across the board. But to me, both of them were fine, but Lowe's is a little bit more favorable in that regard. Next, we have the dividend yield. So the dividend yield, again, the Home Depot one is actually, to me, a much better payout than the Lowe's one is because you get a whole percent without it being aggressive. So if this were to be the difference between like 4% and 5%, that might be a little concerning to me because they might be, paying too much in a dividend or the yield might be too high. But seeing that it's under 5% and it's, at 2.76%, that is a really good dividend yield for me to see, especially in this sector. The payout ratio, now the payout ratio here I have is 52.99%. That's what I initially calculated. I've also gotten some other numbers, but as we know, it's always changing. And in their earnings report, they said it was about 55%. I'm sorry, in their earnings call, they said it was about 55%. Now, that's a little high, but again, given that it's Home Depot and that they are still, they're not really doing much growing anymore, I think it's acceptable for them to have a higher payout ratio. And that was actually something else that they mentioned in the earnings call, is that they still plan on increasing their dividend, which during times like these is maybe not the wisest decision. I know that Disney's gotten some backlash for saying that they're going to continue to raise their dividend, but yeah, we'll leave that for your own judgment. You can figure that out on your own if you think that it's a good or bad idea. Maybe actually comment that down below. Should they continue to increase their dividend? Should they hold their dividend where it is during the virus? Or should they maybe consider just suspending their dividend for the time being? And let me know your thoughts on that. And again, but compared to Lowe's, it is a higher payout ratio. So it would be interesting to know why that's such almost, a significant difference between the two of those. Given how similar their operations are, that was actually one of the things that led to me thinking maybe Home Depot is either more profitable than Lowe's is, or maybe they just do a better job with managing their expenses versus their income or revenue. Earnings per share obviously is a lot higher with Home Depot as well, which is good to see without it being completely aggressive. Now at this point, I did look at the stock price and I saw that Home Depot is about double in share price what Lowe's is. So honestly, that earnings per share makes sense. Again, it's not a direct connection between stock price and earnings per share, but it just makes sense when you see it at that price. And lastly is the beta. Now, given current state of the market and with it being very volatile, I've mentioned this before, but real quickly, beta of 1 equals the market. More than 1, you're more volatile than the market. Less than 1, you're less than volatile than the market. So I'm looking for things that are at 1, maybe slightly below 1 in times like this, because I want something that's going to be pretty steady during volatile times. And that's why Home Depot also stood out to me as more favorable than Lowe's is. So once I took a look at those numbers, so their financial ratios, I then decided to take a look at their profit margins, and I found a comparison chart that made it super easy, and I'll put that up on the screen as well while I go through this. So the companies that this compared, there were a few others that I just didn't feel were relevant, like TJ Maxx showed up as one of these competitors, which I guess I could see, but anyway, just to make it easy, I made it down to just Home Depot, Costco, Lowe's, and Walmart. So even Costco and Walmart are a little weird with that because for the most part, they sell their inventory before they actually purchase it, and they both operate on pretty thin margins anyway. So those are a little tough, especially considering they both have a food side, and if grocery stores have like razor thin profit margins. So those are a little weird to leave in here, but they're there, so forget it. And with Home Depot, you could see that the profits between Home Depot and Lowe's are substantial, or at least in the profit margins, which again raises the question to me of why. So one thing here that stood out to me is if you look in the 2008 section, or if you look at Home Depot from 05 to 08, you see that their profit margins declined, which makes sense. That was when the 08 recession happened. But it was on a steady incline since then to getting more and more profitable or increasing those margins. Where on the flip side of that, Lowe's also went down, started to come back up, but then ultimately has never fully recovered from the 08 recession. So it'd be interesting to know, is Lowe's maybe expanding their stores? Are they adding more stores? But, from doing some research, I was actually able to see that Home Depot generally is more profitable, and they just do a better job handling their money. Which again, as the investor, that's one of those key aspects that I like to look for, is just how well do they handle their money? Is it going to the right resources? And do their other numbers support what they're doing with it? So are they still paying a good dividend? Are the share prices staying consistent? There's no crazy news. So after seeing comparisons like this, I was ready to say, you know what, Home Depot is going to be the one. So what I did to kind of get the calculation for if this is going to be a good investment is I used a free cash flow to the firm forecast. Pretty simple, but I know I haven't gone over this in the past, so I'm not going to go into too deep of a dive here. But essentially what I did is, assuming the required rate of return or personal rate of return, I just simply used their weighted average cost of capital. Sorry, that's a tongue twister. The WACC, as some people might know it. And that was at 11.01%, give or take. And this is where I actually got a little confused, but I went with it. So my calculation actually showed that the intrinsic value of Home Depot stock is about $285. Do I actually think the intrinsic value is $285? Probably not, but I don't think it's much less than that. If I had to just throw a number out in the air and say, what do I think Home Depot stock is worth? I would give it anywhere from $250 to $265. That's just my personal opinion. You might have other calculations you do and get a different number from that, or you might just feel differently. You might even be questioning why I'm not trusting my own numbers. And, sometimes the numbers don't lie, but sometimes your gut is also a really good instinct for how much you should be paying for an investment. And that's why I ultimately just stuck with the, $250, $265. So with that being said, kind of my next move, what I did is I went to Yahoo Finance, and I'm doing this now, but I'll just put up an image on the screen so you could see. And at the time of recording this, it's trading at 220, which is awesome. So that means that this is an investment that I want to add to my portfolio. Given how it's substantially lower than what my calculation showed or what I feel the stock is worth, I'm going to place an order at market because I want to buy this as low as possible. So now I will bring you over to my screen and I'll show you where we place that trade on the paper trading. We are at the paper trading, and just a quick review here. My camera is about to die, so I want to go through this quickly. You can see Peloton still not doing well for us. Admittedly, I know I bought that at a high price, but it was kind of a trendy stock when I did the first one, so I thought it would be a good video to do. But we learned our lesson there. VNQ, the Vanguard Real Estate Fund, has done pretty well for us. We gained $270 over the past week. So still overall, we're down on the portfolio. But as we make some smarter investments and I don't do some risky business like Peloton, we should hopefully see this portfolio grow. But with that said, let's go ahead and do trading. We're going to do HD. And yep, so right now it's at 219. It's taking a little bit of a dip, but that could be good for our purposes. And let's go ahead and see if we can add this in there. I forgot how to place a trade. All right, so we'll just give ourselves a nice 23 shares here for this. As you can see down there, it comes out to about $5,000, which is perfect. We'll go ahead and preview. All right, and we will send off that order. So we now went ahead and added Home Depot to our portfolio, and you got to see my thought process behind that. So As always, I hope that this video is helpful for you, or I hope that you enjoyed it and maybe learned something from this today. Any questions, please leave them in the comments section down below. I'll always be happy to help out or address any questions you might have for me. If you found this interesting and think you might want to subscribe, go ahead and do so, and also like the video if you want. But you could be anywhere in the world, but you're right here with me, and I really appreciate that. So thank you so much for your time today, but I hope that you enjoy the rest of your day, and I will see you next time.